Hey everybody, and welcome to Chapter 10. Now, the title of this chapter is The Economics of Banking, but in today's video, we're going to establish the accounting of banking, specifically commercial banking. And so in this video, we're going to be talking about a commercial bank's balance sheet. So we're going to go over what a balance sheet even is for those of you that don't have any accounting in your background, and then we're going to talk about different liabilities and assets these banks have. So, first, and this is a very important equation, not just for this class, but anytime you want to do any sort of investing, read any 10Ks, or take an accounting class. And that's the balance sheet equation, which is that assets will always equal the liabilities a company has plus shareholders' equity. And you should know by now what an asset and liability is, but shareholders' equity is a little bit weird. And the easiest way to define it is just the difference between the value of the firm's assets and liabilities, which means that shareholders' equity is just considered a firm's net worth. So in like the banking world, this is going to be called bank capital. So we really have three different definitions for the same thing. Shareholders' equity is what accountants call it, net worth is what economists call it, and bank capital is what finance people call it. So kind of weird, but it's all going over the same thing. Basically, if this is a privately owned corporation, the shareholders' equity is the extra profit after all operating expenses and liabilities are paid off. If we're talking about the sale of a company, this is what the raw price of a firm is. So if a firm has a total assets of, let's say, $1.2 billion, but it has liabilities of $1 billion, then that means the shareholder equity is worth 200 million. And so that means that if a company wanted to buy the firm, it would probably price it at around $200 million, plus whatever projections they have for the value in the future and whatever. But that's what the book value of the firm is as a whole. Now, let's really zero in on the liabilities part of things. And banks, it is important to remember, are going to raise funds to make investments. Remember that we're talking about for-profit banks. We're talking about Wells Fargo, JP Morgan Chase, etc. Uh, and so they're for profit. They're trying to make money, and they do so by raising these funds for investments. And they do them really in two main ways: through checkable deposits, which we know as checking accounts, which are accounts in which depositors can write checks and use a debit card from. So, uh, if any of you have a debit card, you probably have a checking account. And most of these checkable deposits do not pay interest. However, banks also raise funds through non-transaction deposits. And the main difference between these accounts and checkable deposits is that they're less liquid. And so savings accounts, certificates of deposits, all of these classifications, any time deposit falls under a non-transaction deposit, and these ones pay some interest. And the reason why you're going to get interest or more interest from these non-transaction deposits is because they're less liquid. And as we'll see later on, banks can do more with the money put into these deposits. And it's important to remember when we look at these accounts, there's a classic saying which says that if you're not paying a company to do something, then you're the product. In this case, it seems like banks are just a storage of value for people and that they are just providing a service to individuals. But in reality, you're the ones providing the service to the bank. You're lending them money and they pay you back for doing so, both through interest and then through all the variety of services that banks provide, such as giving you a debit card. And so they're really actually the customer when we look at these methods of raising funds. Now, another important thing to remember is that all these deposits with commercial banks are going to be insured by the FDIC up to $250,000, and banks will have to pay into that, and we're going to get into that a little bit later on. But it's not really a significant risk for you to deposit in a bank. I just wanted to put that in there since I went on that little tangent about us being the lenders. Now, banks will also raise funds by borrowing, and the most popular way they do this is through the federal funds market. And this is where just banks will exchange short-term loans with other banks when they have excess deposits. So if you're looking at a small bank in my hometown in Wyoming, if they issue a large mortgage or get a large mortgage paid back, all of a sudden they have an excess of cash. If this is a $500,000 mortgage and it gets paid back, they suddenly have an extra $500,000. So they may lend it out on the federal funds market to get a little bit of interest on that while they're looking for someone else to lend it out to. Additionally, and you may have heard these referenced to as repos on the repo market, banks will sell securities and agree to repurchase them usually the next day. So that's where you get repo from is repurchase. And these are usually done with just massive, massive companies. We're talking about like Wells Fargo, JP Morgan Chase, etc. And some of the largest corporations in the world will also operate on the repo market, such as Amazon. And the reason why the repo market is so big is it's used to mitigate credit risk and to provide lending collateral. So that what the first part of that statement means is that if a bank has some sort of drop in its value, then it takes time to unwind assets to generate the liquidity necessary to pay off or meet whatever reserve requirement is troubling them. And so what they'll do is they will get cash on the repo market. They'll sell an asset on the repo market, get the cash, and then once things, settle down, usually the next morning, then they will pay back or buy back their asset that they sold on the repo market. And this seems like a weird, like magical kingdom or whatever, but it's important to understand because over $1 trillion in action is done on the repo market every single day. So it is a massive market that not a lot of people know really exists. But now let's move over to the asset side. Banks will acquire assets in a variety of ways. So anytime they have issued a loan out, that loan gets registered as an asset. Anytime they, purchase some sort of security or bond, that is considered an asset. They have ownership over it. Uh, and then they'll also hold on some cash, and these are called their reserves. And any bank asset with cash and deposits with the Fed is considered reserves. Now, I have this note here at the bottom that points out that the Fed actually eliminated any required reserves as of March 20th, 2020, which, in case you see that date, coincides with the COVID-19 recession. So, what happened is that the Fed used to require banks to hold on to a certain amount of cash on hand. However, when COVID hit, there was a ton of panic and a lot of people needed to take out loans. Additionally, as the market started to dry up, there was very little new market activity. And so the Fed, by eliminating the reserve requirement, gave banks the ability to give out more in larger loans to try and stimulate economic activity and to lend out funds to people who need it. So that was the real intention. And as of now, there's no stated intention by the Fed to increase the reserve requirement above zero, but we should expect eventually that they'll do so. Next, let's go over what a bank security is. And this is just any asset that is liquid that can be traded on financial markets. So they're basically just normal securities that banks are allowed to invest in. So they are allowed to hold on to treasury bonds, corporate bonds with investment grade ratings. If you remember, we talked about investment grade and junk bond status, as well as some state and local bonds. So they are only allowed to invest in what are considered to be more stable assets. So you're not going to have banks speculating on, just really sketchy stocks. They're not going to be buying Bitcoin or whatever. These are all considered to be pretty safe investments. However, checking deposits, since they're more liquid for the depositor, are not allowed to be invested into corporate bonds because out of that list, corporate bonds are usually considered to be the most risky. And so there's very strict requirements on what commercial banks can do with deposits. However, and this is a weird one, MBSs are allowed to be invested in by banks. So MBSs right now make up about 55% of all the securities held by commercial banks. So once again, just showing you the magnitude of the situation in 2005 to 2007 about why the housing market was such a big deal. It's because these banks were allowed to buy MBSs as they were considered investment grade corporate bonds, and they gave high returns with very little downside. And banks were able to play a little bit of both sides of the aisle because they were getting interest by issuing the mortgage and then selling the mortgage off and then buying the packaged security. So a little bit of weird there, but shows why the MBSs were such a big problem. Additionally, they make out loans, and these are the largest bank asset. They come into three types: commercial and industrial loans, which are just loans to businesses, consumer loans, which are loans to households, excluding mortgages because they're structured a little bit differently, and then finally mortgages, which all are going to have collateral in the form of the house. And we can see just what I mean by the percent of loans going out being massively in the favor of mortgages. We're always going to be hovering uh, above about 50% since, like 1990, while consumer loans and commercial loans are pretty low. Also, you'll see what I'm talking about, why the Federal Reserve diminished the reserve requirement is because of that drop with COVID. As you can see, a lot of companies desperately needed loans so that they didn't go bankrupt. But on the flip side, consumers, they weren't buying new houses. They weren't going on any trips. They weren't doing anything really speculative, no new cars or anything. And so the bond market just completely dried up.